Hi everyone, Justin here from BDO. I'm a member of the Specialised Valuations Group and I'm joined today by Ashley Weavers and David Tunsey in order to discuss the impact that the year 2020 has had on the local credit market within a South African context. So let's start off by looking at some of the headlines that have stood out above the noise.
Thanks, Justin. Well, I don't think it will come to much of a surprise to many of us that the big headline in 2020 would be the impact that COVID-19 has had on the world in general. COVID-19 was announced as a global pandemic in March this year, which was very shortly after the first case was announced in South Africa. Quickly after that, South Africa entered into a national lockdown, which is arguably one of the strictest and longest lockdowns that took place internationally. If we look at the inflation rate, we will see that it decreased to just above 3% from about 4.5% at the start of the year. The unemployment rate saw an initial increase in the first quarter and then it decreased in the second quarter. This, however, was due to the exclusion of discouraged work seekers. Overall, the expanded unemployment rate saw an overall increase. The sovereign credit rating of South Africa was downgraded to junk status. This means that all three rating agencies rank South African credit as non-investment grade. This was already on the cards before COVID, however, COVID did put this on the fast track. If we look at some of the responses by the institutions of South Africa, we will see that there were many stimulation packages which were partly funded by the International Monetary Fund, and also the repurchase rate was reduced by 300 bips from 6.5% at the start of the year.
With these headlines in mind, what is the impact that we've noticed in the local credit market?
Well, there has been a notable decline in the foreign bond holdings, indicating that foreign investors have been moving away from the South African bond market, despite the traditionally high returns gained. There are a few reasons for this, however, one being the ratings downgrade impacting the fund's ability to invest in South Africa. The uncertainty in the market caused a general trend of funds being returned back to the investors as portfolios were de-risked and investments were turned into cash. Another reason is the reduction of the repurchase rate, which in turn reduces the rate being offered to investors as an incentive for taking on the increased risk. A counterpoint of interest is that some fixed income funds took this opportunity to purchase cheap credit due to the overreaction of the market.
Talking about the returns in the credit market, we've been tracking the bond and swap curve each month in order to see how the credit market has been shifting. What we noted is that around March, there was a major shift in and steepening of the swap curve, with the short-term rates declining, mostly due to the reduction in the repo rate and the long-term rates increasing. This increase or risk premium for longer-term investments is largely due to the long-term risk and uncertainties surrounding COVID-19 and the ratings downgrade to junk status. For us, this spoke volumes about investors' concerns with regards to the long-term structural challenges faced by the South African economy, and that government's interventions within the short term may not be sufficient to fully mitigate these long-term concerns. Subsequent to March, we noted an overall downward shift in the curve as the repo rate was further reduced. This was, however, still more pronounced in the short term as the long-term rates only declined slightly from March levels. On a positive note, regarding SA credit, we do note the following. Our debt maturity is reasonably well scattered, with the average amount due per annum of 4% with a 3% standard deviation. The larger maturity years are 2021 and 2026, which account for 10 and 11% of our total debt respectively. For our risk-neutral investors, SA bonds are currently offering high yields on the long end of the curve, which is actually trading above the swap curve. And if one is comfortable with government's ability to finance their debt based on the financial vehicles available to them, then South Africa could represent good returns. I will, however, note that when dealing with the credit landscape, context is important, and in the case of South Africa, we need to assess the risks and returns offered to investors in relation to how we stack up against other emerging markets. For more information on this, please be on the lookout for our next BDO SVG LinkedIn post.
Thanks, Dave. Wow, a lot has happened in 2020. Just to summarize the key standout points. Firstly, short-term instruments have experienced a reduction in the returns being offered, which is largely driven by that reduction in the repo rate. And secondly, there's an increased uncertainty and risk associated with longer-term instruments, which have therefore experienced an increase in the returns being offered as compensation. And this leaves good returns open to investors who are willing to take on that additional risk. Thank you to both David and Ashley for helping us summarize the relevant headlines and explain the impact that this has had on the local credit market. If you would like more of a macroeconomic analysis or a brief market update performed by our Specialist Valuations team, please take a look at our LinkedIn page, which we will link to in the description. Thanks. See you next time.